After several years of above-average gains in net wealth, falling home values is acting as a bit of a reality check for many. StatsCan said this week that with home prices down $419 billion in aggregate and stocks down by more than $530 billion, our collective wealth fell $1 trillion in the 3 months between April and June. For many, those are paper losses that would not be cause for concern, but even there, the psychological effect is powerful. So how should we be thinking about our finances in the face of ongoing inflation and falling prices for the things we do own? Som Seif is founder and CEO of Purpose Financial. Som, great to have you with us.
Always great to be here, Amanda.
So there is this psychological impact, even if you weren't planning to sell your home, you know that its value was higher a few months back than it is today. What's your advice to people about how to think about that on-paper wealth or a lack of it and the changes that happen?
Yeah, I mean, I think that one of the things that we all have to remember is that not many of us remember what inflation and higher interest rates are like. And you know, they are nasty at times, and you know, I think that we see that most closely in the impact, of course, on the costs that we have, but also in the prices of our homes, which we don't see every day, but we feel them, right? Mm-hmm. You know, the cost of your mortgage is increasing, and most Canadians, of course, have a variable rate mortgage, and of course, no one has a mortgage rate that goes beyond 5 years. So, you know, these rates are going to have impact on the average Canadian broadly. And I think it's just something that we all have to recognize that, you know, when we think about long-term value and creation of from an investment perspective, that, you know, there will be short-term bumps, both in the stock market, where we see it every day, but also in our, other assets, including our homes. And we just have to recognize that, you know, are we in this for the short term or are we in this for the long term? And if you are in the long term, then you'll be okay.
And so completely, if you're very young, you set it and forget it, right? You can get your whatever savings you've got in the right position and not worry too much about year in, year out fluctuations. A lot of people don't have that advantage if they're a little bit older, if they're looking, retirement is around the corner, and what the market is doing can be very upsetting, right? When you see massive declines like we've seen in the value of stocks, even though you can argue that where they sit today, Som, is about right, is kind of fair value, and that it was actually overvaluation before. We won't have that debate. But if you're somebody who's looking at the markets and feeling kind of sick to your stomach, what do you tell people about that? If they do need the money sometime soon and this feels bad, the temptation, of course, is to make changes, is to sell things. What do you say?
Well, the most important thing is we always start with this. You have to be diversified. If you aren't diversified, you know, it's going to be, you're going to see pain a little bit more. But the other thing is, if you have current income needs, if you're in a retirement or close to retirement, you should be managing your portfolio to have current income cash flow coming out of it. And so, even though the mark to market of your prices might go up and down, if it's paying off good cash flow, dividends, income that meet your needs, then you're okay. You don't have to sell securities in down markets to fund your lifestyle. And I think that's really the big question. If you are funding assets to fund your lifestyle, or selling assets to fund your lifestyle, then that can be a difficult thing. And I think it's time to make a change in the way you're structuring your portfolios, if so.
Just a few seconds, but the other end of the spectrum is young people. Savings are the first things to go when times get tough, costs go up, there's inflation. How important is it to be thinking about trying to set some money aside in markets like this if you are in it for the long haul?
100%. I mean, Amanda, every year you don't save, you're losing the benefit of compounding. And so you have to have a savings rate that is consistent. It's not the thing that is, call it the slush fund. Actually you should be doing other things and cutting back on other expenses, but maintaining your savings wherever possible.
And just super quickly here, do you expect things to improve in the year ahead?
I think in the year ahead, yes, but I think in the next 6 months, I think we have a lot more volatility and risk that we still have to kind of flush out. We're watching the central banks figure out inflation in real time, and it's a nasty thing. And so we have to be cognizant that it could be still some volatility to go.
Som, so good to have you. Appreciate your time.
Great to be here, Amanda.
Som Seif is the founder and CEO of Purpose Financial. Time for the takeaway, and who decides when enough is enough? Before the pandemic, the province of Ontario passed a law limiting wage increases for public sector employees in the province, capping pay raises at 1%. That was back when inflation was running close to 2%, meaning that at its passing, Bill 124 was effectively lowering the wages of a host of public employees by a full percentage point per year. for 3 years. Now throw in inflation at 40-year highs and you add insult to injury. Wonder why so many nurses are burnt out and leaving the profession? It's not just because of the stress and work of the pandemic. Hard as that was, you just don't see the same phenomenon with doctors. The employees affected, including nurses, teachers, university administrators, engineers, and more, launched a court challenge this week against Bill 124. They will argue that by taking wage bargaining off the table, it robs them of the right to negotiate. They will also argue that since the professions in question are dominated by women, there's an inherent bias in it too. Police and firefighters faced no such wage cap. But then again, calling it a cap is a misnomer, since it was always a reduction. The whole thing highlights a problem with wages that stretches into the private sector. Many of us are governed by contracts which build in wage increases in an effort to protect us from inflation eroding our pay. Those that don't have those increases are being paid less after inflation. Some years, the built-in increase isn't quite enough and everyone takes a pay cut. Of course, it's easier for a business to promise wage increases over time if inflation has been relatively stable, so that the business can have some predictability in its spending. But what about now, when inflation is high and anything but stable? Do we believe the central bank that it will get it under control, in which case an increase of 3% might just be fine? Or do we see our own annual costs and calculate that we need something much higher? In the end, it will be a process of trial and error, and the rough justice of the market will set the pace. My takeaway, any employer that imposes a below-inflation limit on pay increases is cutting your pay, and at the very least should have the decency to admit that. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.